Hey folks, Rachana Ranade here, and I welcome you all to a very interesting podcast that I did with Mr. Mayuresh Joshi, and he's the head of equity research at William O'Neill. I'll tell you, it was such a wonderful podcast. It was almost a 1 hour plus podcast, and my members from Invest in India community who attended this podcast, they were just going on asking questions. And at one point in time, I was like, okay, now we'll have to stop this podcast. It's more than 1 hour now. So what I've done is I've taken out some best chunks of that podcast, and I'm presenting that in front of you. But if you are interested to join such podcasts where amazing guests come on our show, of course, it's an online podcast. You can definitely check out our Invest in India community where we have such guests. And this community is mainly of like minded people who discuss about long term investments, who discuss about having edge over knowledge. And if you join this community, not only you will get all these perks, but the last one specifically, where we run challenges every month. And this is a way where you can actually step up your knowledge in a very disciplined but yet fun filled manner. So don't forget to check out our community. Link is there in the description and in the pinned comment below. And this entire podcast had so many answers to so many questions. So if you want to have a look at this, all these questions have been discussed in this podcast. I'm sure it's going to be a fun filled session. So keep on watching the video till the end. The most important topic, where market is right now. We will talk about the levels, this, that, whatever,
Right.
afterwards. But I think the biggest bull run that we saw, one of the biggest, I should say, one of the biggest bull runs we saw since the bottommost point of COVID till the recent highs, which was around 26,300.
Correct.
I think a major emotional drive that came in was India story, right? And it was not only emotional, I'm sure it was backed by a lot of numbers as well. So if you could just help us understand that if we are betting on the India story, what do you feel is your long term outlook on India? Because right now, the moment we say that array but GDP numbers are slowing down, the consumption story is slowing down, I have seen some people who have been giving, I mean, who are in two minds right now. Ki India story, is it a myth or is it a reality? So I think we should start with the very first point, your thoughts on our Indian economy.
So, very good evening, Ratnaji. Pleasure to be on your show. Thank you so much for inviting. So, before we start, right, I remember the Silsila song, and I believe everybody remembers the Silsila song, Amitabh Bachchan ji ka famous song. ये कहाँ आ गए हम यूं ही साथ साथ चलते, right? So the last 4 years, frankly, the market has been on a one-way spree, right? Except in June till September and December to March of that year, when you saw a drawdown happening into the market. But large part of the last 4 years, the market has given a one-way linear move. Hardly the Nifty has corrected by 5% maximum until the recent correction. And the bounce back came back immediately the next day. So people never even realized post-COVID that there was anything by the name of a correction, and markets actually correct by the term that they do historically. So if you go back in history, right, so we put out a very interesting graph where we've analyzed how the Sensex has behaved in the last 20 years. And surprisingly, Ratnaji, I think in the last 20 years, 17 years, the Sensex has given a positive return, even if there has been a drawdown internally in that year itself. So except for 3 years, which is the 2008 crash, where the drawdown persisted and the Sensex closed in the negative, the drawdown was as bad as 60 odd percent. In 2011, when you had the second wave of the financial crisis, which hit global markets, 26% drawdown, and 2015, a 16% drawdown. If you leave these 3 years, there have been 14 instances where the markets have corrected 10% intra-year, right, within a financial year, and where it has closed in the positive. 4 instances where the markets have corrected more than 15% and still closed in the positive. As we stand, right, and if we forget the Silsila song for a moment, as I just discussed, we are down 15%, very frankly, right? Is there worst? That might probably happen. Small cap, mid caps have been hit even more. So I will take you to the 2004 phase, right? I mean, if in long-term investors who were there in during that phase, 2004 to 2008 was one of the biggest bull runs that we probably had witnessed, right? And each of these years, Ratnaji, I think there is a peculiar characteristic. 2004, the drawdown was 27%. Year-end, Sensex closed 12% positive. 2005, 13% drawdown intra-year, and the Sensex closed 42% positive.
Whoa.
2006 and 7 at 29 and 15% drawdown, and the Sensex has closed 47% positive for each of those years.
You're talking
I
about
think
calendar year or a financial year?
the entire calendar.
Entire calendar. Okay.
So if you probably have that into your perspective, what really is happening right now is the last 4 years we had a tremendous run.
Yeah.
Valuations had become a little bit more expensive for the market. There were no two ways about it. Main index, including the broader markets. And therefore, I think a lot of froth had genuinely built up for the markets. People who had got in and stayed put with their investments, specifically in the broader markets, 8 time, 10 time, 12 time return, which happens over 10 or 12 years, happened in 2 or 3 years, right?
Yeah.
So the appetite of assuming that returns will keep on coming at the same pace, unfortunately, it does not happen in the market.
Yeah.
But does that mean that the markets are now done and dusted? The India growth story, as you were just saying, is completely over. We see a lot of memes, right, which are become a very commonality आजकल. Bear hospital में है, the bull is lying in the bed, so on and
Yeah.
so forth. But I think the India growth story continues. There obviously, I think the instances that I'm saying become part and parcel of the market. The biggest drivers for the Indian markets, as we discuss ahead, will be earnings, which should come back. The consumption story, which is expected to grow exponentially in the Indian context. Manufacturing, which has taken a good, strong foothold, expected to increase. And in terms of our own PPP, right, we are already there in the top four. Because of all these factors put together, we'll obviously be having a larger share in the next few years. So backdrops, drawdowns will persist, but the India growth story continues. So I think I remain extremely, extremely bullish and optimistic on India over the medium term.
Though we are so much optimistic about the India story, what's wrong with the FIIs? I mean, have they lost have they lost faith in our India story, or what's the scenario?
So again, I'll give a very interesting perspective. So FIs basically betted on the India story, specifically post-COVID, because growth came back very, very strongly.
Yeah.
So if you map our GDP growth and if you map our earnings growth, they were going hand in hand. So if you're growing at 8-9%, and if the market moved 20% compounded every year, earnings, Rachana ji, were also growing at 20 to 22%. So I think it was not that the markets were at a super premium. Earnings were in place as far as the overall story was concerned, as far as India is concerned. So if I take you to Q1, Q2, Q3 of FY24, which is exactly last financial year,
Correct.
and average earnings growth was anywhere between 20 to 25%, right? That has slowed down. Now, what the FIs were betting as a premium to the India story was that earnings growth will continue at that 20-25%, which is far higher than any economy in the world. China is in a mess. US में debt का बहुत बड़ा issue है.
Exactly.
Europe has core inflation problems. Europe is grappling with still post-war issues, inflation issues, core inflation issues, etc. And a lot of these Southeast Asian economies that we track also, their economies are not that large as India is. And therefore, I think if you look outside the mother market, which is the US market, outside China, and let's leave aside Japan, so ex-Japan for the time being, I think the Indian market growth has come off. But is it structural or is it cyclical? I think that is the question we need to ask ourselves.
Correct.
It is not structural for the same reason and for the simple reason that every market goes through a cyclical phase. If you're growing at 25% for through 2 years, on that base, you cannot expect to grow continuously over 4 years.
Correct.
So there will be a period where you'll plateau, you will come off a little bit, which is exactly what is happening.
Correct.
And the government has done the right measures. आज कुंभ के वजह से, I think Q4 GDP bump होगा. Because of tax cuts that has happened, Q1 you will see consumption and exponential spending coming through and investments hopefully coming through as well. And therefore corporate earnings bottoming out. And as we always say in the markets, right? Markets are a slave of earnings.
Yeah.
Earnings अगर वापस आएंगे, तो FIs को झक मार के वापस आना पड़ेगा.
True. So true. So, I mean, you did mention about Kumbh, which could be a potential trigger for the GDP. A lot of that is also being talked about. How much could it contribute to our economy as well? So it's really interesting to read through all such things as well, right?
Oh,
Uh,
absolutely. In fact, I mean, look at the data points. Like people from all over the country came. Flight bookings
yeah,
हुई है,
yeah,
गाड़ियां लेके आई हैं, hotels में खाया है, on the way hotels में खाए in different states. So I think it's a huge multiplier.
absolutely. So let me take you back to the point that you mentioned that yes, FIIs will also. I mean, they let's say they were betting on the earnings growth, and like you said, it's impossible to grow 25% every quarter or every year. It just can't go on rapidly going up and up. So maybe there'll be a point where we'll plateau maybe, and then the overall base effect will itself come down, and then maybe growing at a higher pace could make sense, right? But one more point for the FIIs, other than earnings, was the overall Dixie or DXY versus our market, which has a relation between themselves. So just for those who are not really aware about what is dollar index, if you could just help them understand this relation between dollar index and Nifty as well, because I think that also triggered some sell off for the FIs.
Oh, absolutely. So I think very simple. Dollar index is a combination of six currencies. So I think they map these six currencies against how the US dollar moves. So which are these six currencies? You've got the euro, you've got the British pound, you've got the Swiss franc, you've got the Swedish krona, you've got the yen. And therefore, I think a combination of these six currencies determine economies which are dependent in terms of dollar flows. A large part of the dollar migration, and it has not just happened in India. I think we talk about FIs exiting India. FIs have exited a lot of emerging markets to a large extent, right? Because the logic was very simple. The bond yield, right, which is the safest instrument in the whole world, right? And the US 10-year actually moved to 4.6%. Now, on a 4.6% return, if you look at what premium the Indian equity markets give or Indian markets or emerging markets in general, that gap reduced.
Yeah.
And therefore, I think there was a huge flow towards dollar denominated assets, specifically, I think dollar backed assets, which included your 10-year security or bonds which were dominated in dollars. Having said that, I think what we've typically seen in the past when such outflows probably happen, the dollar index gets affected because ultimately it is pegged to the US dollar. Now, typically throughout 23 and 24, the intermittent corrections that we saw, the dollar index hit 105, 106.
Yes. Yes.
And when it hit 105, 106, it probably plateaued, or जहाँ पे resistance जिसे हम बोलते हैं in market lingo,
Correct.
it probably hit that resistance and it came off.
Yeah.
Now, the shares a very unique relationships with how Nifty moves, right?
Mm.
When the dollar index moves higher, which means that if it is at 100, if it goes to 105,
Mhm.
and if Nifty at that point of time is at 100, it will move to 90.
Correct.
So what I'm saying is it's an inverse relation. So a 5 to 10% dollar index move might mean a 5 to 10% correction in the Nifty.
Mm.
Now, as we stand, the dollar index is at 107. It has hit an all-time high of 110. It has breached its 21 and 50 moving average. And again, I think a lot of institutions for your investors at large, because we track global markets, we speak to a lot of global institutional investors as well. They track technicals as well, right? And they track technicals very, very closely. So
Okay.
if it is breached at 21 and 50 moving average, if it is coming off, I think it becomes a very potent sign. If it starts coming off even more, that inverse relation in Nifty might start happening. And maybe the next few weeks or months, as one common indicator or one parameter that we are tracking, maybe the bottom is probably close as we speak in the next few weeks or next few months.
That which sectors I'll not ask for stocks, but according to you, which sectors could be those which could lead the next rally? Because it's often said that uh, any specific sector or any or few set of stocks
Yeah,
which were the gainer or which were the leaders in the previous rally may or may not be the leaders in this rally. It could
absolutely.
be about the what do we say, that churning of different winners in every cycle.
Absolutely.
So how does a person identify which sectors could lead the rally? What
I
what
think,
is your
yeah. So yeah, you're absolutely right again. I think so. What we've also seen historically in the past, that if a sector which was a leader in the last bull rally, and if that same sector comes as a leader in the next bull rally, maybe the stocks which are leading the next bull rally might completely be different. And we've seen this in the last 60 years history across global markets, right? So at William O'Neill, Rachana ji, I think we've got a very unique way of doing this. Our software does the hard work for us, right?
oh,
So Panray or the filtered list that we've got in Markets with India actually does the hard work for us because we've got our EPS rating rankings, the relative strength rating rankings actually put in. And Panray, our institutional software, actually has a sector rotation graph, which basically pegs in the last 16 quarters data on how sectors have delivered in terms of earnings, how the relative strength was, and which sector, as we speak, are looking good considering historical data and forward estimates that a consensus has built up as far as the market is concerned.
Mhm.
And therefore, we have these sectors which get thrown out through our software or our institutional product, which shows sectors which are going or expected to do well. Now, three or four sectors are actually coming up. One, obviously, the entire rural theme is coming up into our sector focus lists. So you might include stocks which are agrochemicals, you might include stocks which are fertilizers, tractor or farm equipment makers, seed companies, shrimp farm makers. So I've given you a whole host of names that are actually getting thrown out through our list. So rural becomes one area which is clearly getting thrown out. Second, I think healthcare stroke hospitals. A large part of this universe is actually getting thrown out. And if you probably analyze and dissect Q3 numbers, I think they are looking reasonably placed. Third, I think everybody's talking about why capex and why capex should not do well. I think we've divergent views because the budget itself has thrown, Ratnaji, very frankly, if you add supplementary grants, it's a seriously good number. So I think the markets are getting it wrong somewhere is what I feel. Maybe I'm completely wrong, but time will tell. But selective EPC players, selective water treatment companies, selective cement companies are actually getting thrown out in terms of our EPS RS ratings. And fourth, I think selective financials. So I think one of the leading banks, which has underperformed so far, has shown tremendous amount of strength. So I think that bank within the large cap names can actually be the leader of the next bull rally if banks have to come through. And I'll just give you a clue on which letter or alphabet that bank starts from. I think Ekta Kapoor used to have those cereals with that
A
alphabet.
series. Absolutely. Wow. I think you put it more into quiz format, but okay, chalo, no worries. But then you did mention about your software throwing up some lists or indicating some sectors which may perform well. But if I were to ask few questions for the understanding of our viewers right now,
Sure.
at what would be a few parameters from the balance sheet that your software would look at so that they say that acha, okay, if these all things are ticked, I will say okay, it's a fundamentally strong stock, it has a potential to grow in the longer run. No one is interested here कि कल क्या होगा एक हफ्ते के बाद क्या होगा. No one is here to listen about that. But how does a one person understand कि fundamentally it's good and it has a potential maybe for next 5 or 10 years, whatever?
So I think 4 or 5 parameters, the EPS rating rankings that I was just mentioning, I think covers a whole host of details. Internally as back engines, we work towards the same. So the first aspect that we're looking at is that the earnings growth or the top line growth has to be more than 20-25% for the last 3 quarters and for the last 3 annualized years as well. So 3 quarters might be an aberration because there might be some element of other income that comes through, etc., which might skew your numbers from a 3 quarter perspective. But an annualized 3 year number will give you a clear cut picture that if company is able to grow 20-25% compounded every year for the last 3 years, there is something right with the management is probably doing in terms of that particular stock under consideration. The second element is that the margins have to be very, very superior compared to the rest of the pack in the sector that it probably operates. So if it has got superior margins, you're very well assured that even when an industry or a sector probably goes through a cyclical downturn, these companies know how to adapt. These companies know how to adapt themselves. They might have a few quarters of margins which are a little bit lower compared to their own historical averages, but they'll still be better off compared to the industry averages and they know how to tide over crisis periods that sector or the economy is going. Third, the earnings growth similar to top line growth has to be very, very similar to 20-25% last 3 quarters, last 3 years. And the ROE as a benchmark that we're probably putting in is at 17.5% as a canceling feature. So if 17.5% ROE is getting delivered, to put it in layman terms, investor probably expects 17.5% return from that stock to probably get delivered in a year's time. So our belief is that if a company is able to do a 17.5% return based on a 20-25% growth, I think you've got a company which is fundamentally strong. The additional layers that we've put through is promoter pledges, high levels of debt. I think debt levels have to be very, very manageable. Promoter pledges have to be absent. And if promoter pledges are probably there, absolutely minimalistic. Third, contingent liabilities have to be absolutely bare minimum. Because if there is a huge element of contingent liabilities on their balance sheet, it's clearly an off-balance sheet item, but if it accrues at some point of
Yeah.
time, the reversals can happen very, very fast. And fourth, I think from a compliance and a regulatory perspective, I think there has to be no element of question marks either on the management
Mm.
or the promoters. I think if you've got these qualitative checkpoints in terms of data points that the stock is delivering through numbers
Mhm.
and hygiene checkpoints otherwise, I think you've got a good winner on it.
Super. But what we are seeing right now is that even though there are some fundamentally strong stocks, we do see what, let's say, the points that you mentioned in the Cancelim approach that you referred to right now. In spite of having good numbers, in spite of having not only QOQ nice growth, YOY growth, everything is there, everything is ticked off. But just because the market sentiment is bad, these stocks have also taken an equal beating or maybe more beating also. That is also possible.
Correct.
How do I identify signs ki chalo maybe this could be the bottoming out? And now, so this question is at two levels, Mayuresh. One is at a stock level. Ki I know that
Sure.
this is a fundamentally strong stock, but still it has gone down by like 30, 35, 40%. Now
Correct.
I want to know that how to look out for signs ki this might be the bottoming out of the stock. And same question for a zoomed out view, that I know market is also fundamentally strong based on the economic factors that we talked about in the beginning of
Sure.
our discussion. In spite of that, markets have corrected. It's a healthy correction. Lala, we did discuss about that. But then how do I understand that, okay, this could be a phase, or these are three, 4 points which are leading towards a market bottoming out?
Perfect. So I think let's start with the macro picture and then come down to the micro picture,
Sure,
right?
sure.
So if you probably look at the macro picture, right, there are three, four elements that probably happen as far as the Indian economy is concerned. And just let's talk about the Indian economy because that's where we are interested in, right?
Sure.
One, in terms of our deficits, both fiscal as well as current account deficits, how are they placed? So
Mhm.
the finance minister, the exchequer has very, very succinctly put it in the budget right now that we're on the fiscal path and that government capex is going to continue at a good pace. So those two aspects are going to continue. GST collection, tax collections might continue at a good pace. Now, there might be question marks that if the economy is slowing down and with the
Mm,
tax cuts, a large part of the heavy lifting will have to be done by select individuals as far as direct tax is concerned.
yeah.
And what happens to GST if the economy probably slows down?
Mm,
With the tax cuts coming through, I think 1 lakh crore into the system will basically mean that a large part of that pool will either get saved or a large part of that pool will get spent in the system. Now, let's assume nobody knows the figures, whether it's 20, 80, 30, 40. But let's go with the ratio of 40, 60, where 40% might get saved, 60% might get saved, spent in the economy. If 40% gets saved, where will those savings go, right? Either it goes into fixed deposits, PPFs, or it comes back to the markets in form of SIPs. So either or, I think the banking system, which was affected because of lower deposit growth, has larger deposits coming their way
mm.
because interest rate cuts, as we are seeing it, because the US might delay it, the rest of the globe is probably might going to delay it as
True,
well,
true.
would mean that there might be accretion toward deposits. And as banking deposits improve, I think a large part of that pool might come down in terms of coming back as an asset pool for giving advances for institutions as an investment spends and manufacturing coming back. The second aspect, obviously, here that we are speaking about is the spending element. And if spending comes through, the multiplier effect is huge because that gives boost not just to our GDP, but it also gives boost to private capex to come through, which has been lagging. So if these elements starts coming through, the three engines that we speak about in terms of investments, consumption, and expenditure, I think all these three elements that support GDP will start coming back. And GDP, which has been languishing at a micro level, at a macro level at around 6.2, will
Mhm.
start showing signs of improvement as we head into the second half of the next financial year. Now, as that happens, as private capex comes in, consumption is back, investments is back, earnings, which had slowed down, will start coming back as well, right?
Correct.
So as earnings starts coming back, the markets function in terms of re-rating of numbers and markets will
Mm.
always look 4 quarters, 8 quarters down the line. हम एनालिस्ट लोगों को वो बहुत आदत होती है एक्सेल शीट पे कि you put in
Yeah.
forward numbers, make a bear case, bull case.
Mm.
So we'll make a bull case and a base case at that point of time that
Yeah.
markets earnings are improving and next year it will be even more. As you said,
Mm.
the base for the first half will be lower, next half's base will be even higher.
Correct, correct.
So earnings coming back will mean that FIs will have no choice. FIs will say, भैया Indian markets में वापस earnings आ रही हैं,
Hmm.
US ठीक है. Where is the other option that is available at this point of time, where there is economic stability, political stability, regulatory stability? And we should actually commend both the RBI and SEBI for doing a good job in terms of how they have regulated the markets. And therefore, as these elements starts coming through, I think the lacuna or the fag effect that the markets were probably facing will come off. Earnings have clearly come off, which means that the price earnings multiple has also come off at this juncture. And we are close to 15-year averages as we speak. तो यहाँ से मार्केट और ज्यादा गिर गया, so it becomes even more attractive from an earnings perspective. And therefore, I think the placement that we have macro-wise translating into micro might actually relate that as we head, as I said, next few weeks, थोड़ी तकलीफ होगी. But if we go through this periodicity of pain and survive this, which we should, I think, as sane investors, I think the first quarter say, I think bottoming out process start hoga. And I'm pretty sure that when we speak again, I think hopefully next year,
Definitely, we will.
out of 21 years, we'll be saying that 18 years, the Sensex closed in the positive.
Should there be a reshuffling of portfolio or whatever is the portfolio right now, the diversification, should that remain the same?
So I think ideally, I think a large part of your portfolio mix, if it was skewed towards mid cap, large caps, which has been the case
Yeah.
again, as we've seen that in the last 3 years, 4 years. Agar rally milti hai in the next rally which comes through, right? The weak stocks or stocks which are fundamentally not strong, you please get out of that. So I think that
Okay.
is the most sincere advice that I can give you.
True.
But again, I think a large part of the market this year will move, as I said, as our software is throwing out, is towards domestic stories largely. So I think domestic stories and a mix of that which I just mentioned might continue doing well, at least for this fiscal as we speak.
But like you mentioned right now, right? Mid caps, small caps, they have beaten down quite a bit. But if we were to see a rally in the next few weeks slash months, like you mentioned, could that rally be led by small caps, mid caps, large caps? Or I mean, how would it go according
So
to you?
typical cycles, if you look at cycles again, right, and if you go at in past history, in how cycles have behaved, the first move will always be led by large caps. So large caps will lead the first move for the markets because the confidence is still not there, right? The confidence is still to be with large caps. Once that confidence comes and the market has moved a good 5, 6, 8%, where large caps have moved 10, 15% to a certain extent. Again, hypothetical numbers is what I'm putting through. The confidence in mid caps and small caps starts coming back. And again, I think the kind of beta that you create, Rachana ji, I think all of us are aware, right? Multi-baggers come in from the mid-cap and the small-cap universe. Yes, the time will come, but the mid-cap, small-cap rally always comes with a quarter or a couple of quarters lag effect compared to the large cap.
Got it. Got it. So right now you're saying that I'll tell you the psyche why I asked this question. That
Sure.
if anyone, let's say, was invested in small caps, mid caps, and let's say they had seen an unrealized profit of somewhere, let's say 70-80%.
Right.
Let's assume that they were fundamentally strong stocks. Okay.
Sure.
With the overall market sentiment, now they are left with barely 5-10% of the profit now.
Sure.
Now they are not sure that अभी जितना है उतना तो बुक कर लेते हैं, and should we shift it to large caps, or still would it make sense sticking out there and be with that specific set of stocks?
Oh, so I think if that is the precondition that you put, I think it always makes sense to stick around with those group of stocks because ultimately, I think as the market recovers, these stocks will perform because they're fundamentally good stories. And even if they belong to the mid-cap universe, I'm not saying Jo Jita wo Sikandar, right? The large cap is the Raja, but if you're the second best or the third best, you will do well if that sector is doing well, assuming that fundamentals are supported for that sector. And therefore, I think you should hold on. But generally, as a construct, in terms of a portfolio mix itself, I think you should be having a skew of large caps, mid caps, and small caps in your portfolio, and not too much of over allocation towards one particular sector. So I think an appropriate mix would be a good mix of large caps, largish mid caps, and small caps in your overall portfolio. Because if one part of the market is not doing well, the other market might probably suffer.
Got it. One more point. You again, I mean, I'm just repeating this time and again. हम बोलते हैं ना भगवान तथास्तु बोलते रहते हैं. So, so that's why I'm repeating it time and again that markets are nearing bottoms. So if that be so in the next few weeks or whatever, should someone double up their SIP contributions or whatever are the SIP contributions उतना ही रहना चाहिए, or is it a time that we should start buying if someone is buying directly into equity? So two approaches I'm asking you. One, if a person is going through mutual fund investment only. So see, I know for a fact, I think everyone is continuing with the SIPs right now. Majority of the sane investors are continuing with the SIPs. Question is, should that be doubled up? Is that a good time if people have money in hand? Is a big disclaimer. But I think again, a lot of people still may have money in their hands as well. If that be so, does it make sense doubling up SIPs if it is on the mutual funds front, and if it is in the stocks front, good time to start averaging or not?
So just as a joke, I think the point here will be, is anybody going to pay capital gains tax this year, right? When they report their ITR. So,
Ah,
but putting that aside, I think whether you double up or not, right? I think having a systematic plan in place is very, very critical.
hmm,
Market conditions like this, I think you should continue with your SIPs. That's point number one. Second, I think as a step-up measure, every succeeding year, you should probably be having one more SIP that probably gets added. By one more SIP, I'm not saying by an absolute amount. I think you're having 10,000 rupees worth of SIP. Next year, it should be around 12,000
hmm,
of SIP. So I think every step up should happen every succeeding year, because as you continue aging, I think that contributes significantly from a compounded growth perspective. So whether you should be putting lump sum if you have not invested, just as a corollary to your question at this juncture, if you've got the money at this point of time, the option would be to probably have it in three tranches. Have one tranche if it corrects further, one more tranche if it corrects further, one more tranche. So I think you're safely assuming that your lump sums are also getting averaged out, and your impact cost is relatively lesser.
hmm,
Because your lump sum investment will have that NEV effect immediately. A SIP probably has that in a calibrated manner. The second, in terms of your direct equity investment, again, I think it should be a multi-asset allocation strategy that you should be deploying. And why I'm saying this is equities will do well over the next 8 to 10 years. But again, as a diversification, it's always better that a part of your portfolio happens towards bonds, a part in terms of either gold ETFs, as an example,
hmm,
because they become a sort of a hedge when equities are not doing well, and protect the kind of downside risk or drawdowns that get felt in terms of watching your portfolio zero
hmm.
when the market's correct. So I think that's always a better strategy to have a multidisciplinary.
True, true. You mentioned about putting the first chunk, then the second chunk, and the third chunk. So if I may ask, what could be that level where the third chunk should be deployed? Nifty
So
level.
I'll give you a very interesting data point, right?
Okay.
So again, what we've seen in the last 10 years, right? The average correction for the market has been 88 days. 88
Okay.
days, right? The maximum correction was from March 15 to September 15th, which lasted 188 days. That was a continuous period where the correction lasted. The least was COVID, 40 days. The current correction has lasted for 152 days, right?
Hmm,
Now, the assumption here is that if you go by the average, we are already way above average. If
hmm,
you are almost going to hit the peak, you are probably looking at 23 trading sessions, where you look at the March 15th peak of the maximum run where the drawdown probably persisted. So another 23 trading sessions and we'll be close to the longer term hit ratio that we probably done.
correct.
In terms of average drawdowns, that same period of March 15 to September 15 was a 22% drawdown.
Mhm,
The April 2022 to June 22 phase was a 15% drawdown, 18% drawdown.
mhm,
And we are currently at a 15% drawdown.
correct.
Now, if I have to just play with numbers, and I'm just purely playing with numbers, कि यहाँ से अगर मैं देखता हूँ कि maximum drawdown जो 22% था,
Hmm,
यहाँ से और 7% का correction है to reach there. So
mhm,
even if you assume that you correct 5% more, right? We are close to
correct.
that 20-21% mark. A 5% correction more from E's current level, I'm not scaring everybody, will probably mean a 1100 point drop on the Nifty, right?
Hmm, hmm,
And 1100 point drop on the Nifty will mean that the Nifty reaches 21,000 in terms of levels. अर्निंग्स में जो डाउनग्रेड्स आए हैं is around the pegging was FY27 exit number should be around 1200. It has now come down to an average consensus of 1150. Now जो हम सिंपल रेशियो लगाते हैं अरिथमेटिक में 21,000 डिवाइड बाय 1150 टू गेट योर पी रेशियो,
hmm,
निफ्टी पी विल कम लेस देन 80 टाइम्स.
hmm.
कोविड में ये पी 16 टाइम पे आई थी. आज कोविड
Oh.
पीरियड नहीं है, स्ट्रक्चरल ड्रॉडाउन नहीं है. There is no other elements that we are seeing now on the horizon which will make us feel that earnings are going down the cliff. SEB situation nahi hai. And why I'm saying this is the latest figure on the PAT earnings have shown stability. Last 2 quarters it was 4%.
Yeah.
It has shown a 5% rise.
Correct.
With the Kumbh that we spoke, the Cuban tax cuts that we are saying, if there is an increased scope of earnings that is going to come through, I think एक मोटा मोटी अगर आप मान के भी चलते हो कि 5 से 7% का drawdown, assuming historically on what you've seen as the worst drawdowns on history that goes by, maybe 1100, 1200, 1300 odd points, which makes it even more attractive from a Nifty P ratio. So to answer your question, one third now, one third 500 point drop, one third another 500 from there.
But one
अगर
third,
हुआ तो, अगर नहीं हुआ तो.
but one third now makes sense, is what you're saying.
Yeah, absolutely. Because I think what happens is you're going in lump sum, right?
Yeah.
So you don't want to get impacted if the market goes, say, I'm saying 1,000, 1,000. मुझे तो पता नहीं है markets
And
don't
true,
move
true.
all of our
No
combined
one
wisdom.
knows.
Yeah.
That's
So
true.
because of the impact cost, I think you should be averaging out as a lump sum investment. Just a small advice to investors that please keep on reading. Please keep on listening to Rachana ji. I think she has very, very insightful podcasts, messages, reports that she brings out with. And last but not the least, I think keep faith in the markets. We always go through these phases. It's not unique that the markets will go through what we are going through at this juncture. Why I'm smiling is because my belief is that India is a great story. You guys specifically, if you're around 30, below 30, I think you've got a great future. India is a great, great story to probably play out with as well. And I'll just end this session with a quote that our ex-founder has given. William O'Neill had a very, very famous quote. In fact, you should read his book as well, How to Make Money in Stocks. All that I'm speaking has been incorporated in his book, How to Make Money in Stocks. And there is a very famous quote that he probably puts through, which is what I'm going to put through right now, that I've never met a successful pessimist. So I think be optimistic and the markets will
Wow,
do.
wow, 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 wow. क्या बात है? I hope you enjoyed this podcast. And if you want to join such podcasts live online, as I mentioned, don't forget to check out the links in the description box and pin comment below. I'll see you in the next one. Till then, take care. Jai Hind and bye bye.